Video promise. You'll learn the 5 warning signs that separate a safe high dividend from a trap that can wipe out your capital. Title: The Dividend Trap, When High Yields Signal Danger. Hook: midnight to 0:15, Ida, attention. In 2008, General Electric paid a dividend of $1.24 per share. Millions of retirees counted on that check. 10 years later, it was 4 cents. And the stock? Down 70%. This is the dividend trap. And today, I'll show you exactly how to spot it before it bites. I've spent 50 years watching investors get seduced by a single number on a stock screener. The yield: 8%, 10%, sometimes 12%. And the thinking goes, if a company's paying me that much just to hold it, how can I lose? Well, ask the GE retirees. Ask the Frontier Communications shareholders. Ask the folks who trusted Kraft Heinz. A high yield isn't always a gift. Sometimes, it's a warning siren. And by the end of this video, you'll know the difference. The 5th sign is the one almost nobody talks about. Here's something most people don't understand. A dividend yield is just math. It's the annual dividend divided by the stock price. So there are only 2 ways a yield goes up. The company raises the dividend, or the stock price falls. When a healthy company raises its dividend, that's a good sign. Coca-Cola has raised its dividend for over 60 consecutive years. That's called a dividend king. But when a stock price collapses, the yield shoots up mechanically. Nothing about the business got better. The math just made the number look attractive. Take AT&T in 2021. The stock drifted down all year. By the fall, the yield had climbed to over 7%. Income investors saw that number and piled in. Then in February 2022, AT&T slashed its dividend by almost half, from $2.08 a year to $1.11. The stock dropped another 20% in the weeks that followed. The lesson? A yield above 6% in a low-rate environment isn't a bargain. It's a question the market is asking. And the question is, can this dividend actually survive? But here's where the story gets really uncomfortable. If you remember nothing else from this video, remember this. The payout ratio. It's simple. Take the annual dividend. Divide it by the company's earnings per share. That's the percentage of profits going to shareholders as dividends. A healthy payout ratio? Usually under 60% for most industries. Maybe up to 75% for a mature utility. Above 90%? You're in yellow flag territory. Above 100%? The company is paying out more than it earns. And that can only last so long before something breaks. Kraft Heinz is a textbook case. In 2018, the company's payout ratio climbed above 100%. The brand portfolio was aging. Sales were falling. But the dividend? Still generous at $2.50 per share. Investors clung to it. Then on February 21, 2019, Kraft Heinz cut the dividend by 36%. Wrote down $15.4 billion in goodwill. The stock dropped 27% in a single day. From $90 in 2017 to around $25 by 2020. A company paying you more than it earns is borrowing from its own future. And eventually, the bill arrives. Here's the second thing to check. Before you trust any high yield, look at the 3-year trend in revenue and earnings. Not 1 quarter. 3 years. Because no management team cuts a dividend lightly. It's the last thing to go. They'll cut capital spending. They'll lay off workers. They'll sell assets. Then, finally, they cut the dividend. By the time it happens, the rot is usually 3 to 5 years old. General Electric is the perfect example. Revenue peaked in 2008 at $182 billion. By 2017, it was down to $122 billion. Earnings? Collapsing. Debt? Ballooning past $134 billion in long-term obligations. And yet, all through those warning years, GE kept paying a dividend. Investors kept buying for the yield. The board even raised it briefly in 2014 and 2015. And then in November 2017 came the first cut. 50%. A year later, another cut, down to 4 cents. A 97% reduction from the 2008 level. The signs were there for a decade. Revenue falling. Debt rising. Payout ratio creeping up. But the yield kept calling investors in, right up to the cliff. And the fifth warning sign? That's the one even experienced investors miss. Here's the fifth sign. And it's subtle. Sometimes it's not one company in trouble. It's the whole industry. When an entire sector is yielding 7, 8, 9%, the market is telling you something. It's pricing in decline. Think about traditional telecom around 2020. AT&T, Verizon, Lumen Technologies. All yielding 5 to 7%. Why? Because the market didn't believe their dividends could survive the transition to 5G, cord-cutting, and crushing debt loads. Lumen, formerly CenturyLink, was paying a 25-cent quarterly dividend in 2021 with a yield over 8%. In August 2022, they eliminated it entirely. Stock dropped from $13 to $5 in weeks. When a whole industry offers abnormally high yields, you're being paid extra because the risk is real. Not because the market is inefficient. Not because you spotted something Wall Street missed. Circle of competence matters here. If you don't understand why a sector is yielding double the market average, you probably shouldn't own it for the yield. Here's what 50 years of watching dividends has taught me. A sustainable dividend is paid from profits. A dangerous dividend is paid from hope. And the market will always, eventually, tell the difference. Before you buy any high-yield stock, ask 5 questions. Is the payout ratio under 75%? Is revenue growing over 3 years? Is debt stable or falling? Is the yield reasonable versus the company's own history? And is the rest of the sector yielding the same, or is this one an outlier? If 3 or more of those answers concern you, that yield isn't income. It's bait. Remember what Graham taught us. Price is what you pay. Value is what you get. And a dividend you can't collect next year isn't really yours today. Now I want to hear from you. Have you ever been burned by a dividend cut? Or dodged one by checking the fundamentals first? Drop the ticker in the comments. I read every one. If this changed how you look at yield, hit subscribe. Tomorrow, we're looking at market history, specifically, what the 1973 bear market can teach us about today. This one's going to surprise you. Remember, this is educational content, not financial advice. Always do your own research.